Here is the overview that you really need to keep in mind. The first sneaky thing that always derails your loan application, not knowing the loan's basic requirements. The funny thing is you might be thinking this is so basic, but you have a lot of people who make that mistake. And this is something that we have seen in the last 25 years, 30 years. You have to understand, to qualify for a personal loan, there are a few basic requirements that you'll need to meet, right? Although some of these requirements may vary from lender to lender, most of them are fairly common. And the thing here is that even though they are common, people do not pay attention, which is why those sneaky things, the fact that you're not paying attention, this could derail your loan application. Remember, when we talk about the loan's basic requirements, you got to be 18 years of age or older. You got to be a U.S. resident. You have to be employed on a full-time or part-time basis, including self-employment. This is really important. Self-employment counts. So you don't have to have a 9 to 5 to work for somebody else. No. And nowadays, if you have a gig, a side gig, if you drive for Uber, if you drive for Lyft and whatnot, you basically qualify for a loan. Not a problem. Okay. You must have a valid checking account. This is important. A lot of folks we have covered on this show that there are some loans that do not require personal bank account, but overall, in general, you need to have a valid checking account, and you must have no recent bankruptcies filed against you. So this is actually the gist of the requirements for most loans, most personal loans. And the thing is, if you're not paying attention, you will be denied. So how do you fix this? Pay attention. And most importantly, you want to contact the lender. You want to ask them specifically, what are the requirements? Do not trust what's written on the internet. See, sometimes a lot of lenders, they change their procedures, they change their requirements, and if you just go by what's on the website, you might be surprised. This is why we always tell everybody, hey, listen, give the lender a call, or even better, just go to a branch. If you want to borrow from a credit union or a bank, and if you have a branch that is close to you, go ahead. Just go to a branch. Just be presentable. Walk into a branch and ask the question. Okay, what are the loan's basic requirements? And they'll let you know. They will tell you. The second sneaky thing that always derails your loan is having a high debt to income ratio. This is so important. By the way, welcome back to the show. It's really a pleasure to have you here. I'm very happy to have you here. So take some notes if you want to. So having a high debt to income ratio is something that is a very sneaky element that a lot of folks do not pay attention to, and they're surprised when their ask is denied. You need to have a low debt to income ratio. And when we talk about low debt to income ratio, there are several ways to analyze this metric. Number one, it is a metric that tells the lender whether or not you will have enough disposable income to pay whatever additional loan you're about to embark on, you're about to take. So this is number one. Number two, it tells the lender another thing, whether or not your income is sufficient enough to actually pay the loan, the new loan. And the thing here, you have to understand, if your debt to income ratio is like, let's say 40% or 50% or 60%, then you actually represent a larger risk to the lender, because lenders will love to have borrowers around. They love borrowers who have DTI ratios around 30 or 30% or below. Okay, so this is why, and you really have to watch that metric. And the third thing I want you to really pay attention to here is that do not apply for too much money. If you have a high debt to income ratio, then you want to lower the loan amount that you request. Okay, let's say you want to borrow 25 grand, but after calculations, you realize that your DTI, your current DTI is very high. So what you do is, instead of 25 grand, you can say, you know what? I'm going to go for $18,000 or $17,000 or $15,000. What happens here is that when you reduce the loan amount that you are seeking, a constellation of things happen. So all of a sudden, you appear less of a risk to the lender, because the monthly loan payments is now more decent, more in sync with your budget. So they're more willing to actually approve you Also, your DTI can actually accommodate a new loan of that caliber, of that magnitude. So from 25 grand to 18 grand or 15 grand, there's a big difference. Okay, so this is really important. So how do you fix that? How do you fix having a high debt to income ratio? Well, you make more money, you reduce your current debts, and when you apply for a loan, make sure that the loan amount you apply for is not too much. The third sneaky thing that always derails your loan application is having incomplete or mistaken information on your application. By the way, I want to quickly remind you of today's topic. We're discussing 3 sneaky things that always derail your loan. Okay, so number 1, not knowing the loan's basic requirements. Number 2, having a high debt to income ratio. Number 3, having incomplete or erroneous information on your application. The thing you have to understand here is that you are the one who actually fills out the loan application, right? But you have to pay attention. I mean, when applying for a personal loan, a common mistake that many potential borrowers make is that they forget to include the necessary documents or making a mistake on their application. Remember, I was just talking to you. I said, listen, call the bank or call the credit union, okay, and ask what the requirements are for the specific loan that you want to take, or go to the branch, sit down with the loan rep and let that person fill you in on what kind of application documents you need. Okay, and the thing here is that things depend on every bank, every institution. Now, there are common documents required for a personal loan. For example, I mean, everybody knows personal identification. They want to see something like a government issued photo ID, like maybe your driver's license, passport, or health card, for example. This allows the lender to verify your identity. And the lender also will need to verify your income. So when it comes to income, they will require documents such as your pay stubs, your bank statements, for example, your tax receipts. For example, they might even ask for your 1040 for the last 2 to 3 years, so they have a clear idea of how much you are reporting to the authorities. And some lenders will actually ask the IRS directly to provide them with a tax return transcript. Okay, and there might be other documents that the lender will ask you. For example, the lender might ask you for a utility bill, and because this actually helps them verify things like your address, and they might also ask for your social security number to verify a couple other things. So having incomplete or erroneous information on your application could be a problem. So not also providing your full or legal name, this could be a problem also. So how do you fix this? Just provide your full name. If you have been married, make sure that you actually have legalized all your other names, so that your maiden names is not different from the new name. If you have changed them, make sure that you changed everything, and make sure that you provide the exact documents that the lender actually needs. So one thing I want to talk about here also is that using false or incorrect information is a big deal. Never do that. Okay, if you are listening to me right now, never do this. This is not really it will not help you. I mean, lenders wants to make sure that whatever you provide on your loan application is completely accurate before extending credit. Remember, they have to extend your credit based on the information. Of course, they do their own due diligence, they do their own verification, but if you lie on a loan application, this is a federal offense, this is a federal crime. You could go to jail. Okay, don't ever do it. So if you provide false or incorrect information, the lender will be unable to accurately verify your information, which means your application also could be denied. Okay, so what happens if you lie on a loan application? Again, you can go to jail. But it is a bad idea for several other reasons. Lenders use technology to scan for inaccuracies. Remember, lenders have a lot of experience verifying information on loan applications, and they take many precautions before lending out thousands of dollars. So in addition to that, they use very sophisticated technology, like, things you can never think about. They use that to actually detect potential inaccuracies and fraud. So it's a lot easier for them to spot false information. So you really want to actually avoid that. And one thing you need to make sure that you can, and there are larger legal repercussions. Okay, you can end up in jail, and according to federal law, you can actually serve maximum 14 years. Is it really worth it? No, it's not worth it. And when we talk about incorrect bank account, remember, creditors use your bank account information for the initial loan deposit and future loan payments. So, and what you may not know is that they use your account information to confirm your income as well. Okay, so if you provide a bank account that is not associated with your paycheck or income, the lender may conclude that you don't have a reliable source of income. Really important. So how do you fix this? Don't lie on a loan application. Use correct information and provide the right bank account. That's it. Just play by the rules. Just play by the rules. Okay, very important. So here you have it, the three things that actually, the three sneaky things that always derail your loan application. I just want to quickly talk to you now about, I want to give you a few pro tips. And those pro tips are really important. That will help you actually always get your loan application approved. And I just want to quickly give you today's topic. We're talking about 3 sneaky things that always derail your loan application. Okay, so the thing is, how to get a loan when you keep getting denied. This is an important question to ask, right? Because the bottom line is you want to stop having your ass denied. Well, the first thing you need to do here is that you need to determine the likely reason for your rejection. They'll let you know. The lender will let you know. I mean, they have to let you know. By law, they got to let you know why they denied your ass. Okay, and they can't just, and this actually happens. They will send you a letter. They will talk to you about, and that letter is called a rejection letter. And they will state in that letter the cause of rejection, the cause of denial. So, and once you actually have that letter, read the letter and know exactly why they denied you. And after that, start working back. You want to crawl back into financial stability. First thing, you want to improve your credit score, right? Everything starts with improving your credit score. I mean, the 3 sneaky things that always derail your loan application are not, I mean, your credit score is not part of it, because your credit score is not really a direct result of your action. It's more indirect. In other words, if you don't pay your bills, if you live beyond your means, those are indirect actions that actually impact your credit score. But my point here is that you have to really improve your credit score. The thing is, when we talk about improving your credit score, a lot of folks believe that it's just a numerical question. In other words, I'm gonna go from 600 to 750. That's the goal. But one thing they don't know is that it's not about the end results, it's the journey. Because in trying to improve your credit score, you would acquire a series of routines, a series of practices, a series of habits that will help you improve your financial life overall. And that's what really matters. Things like budgeting, things like reducing your credit utilization ratio, things like reducing your debt to income ratio, things like not requesting new credit all the time, things like paying down your credit card debt. Those things will help you out in the long run. And one thing I want to say here is that if you want to get a loan when you keep getting denied, think about asking someone to co-sign for you. I mean, because think about it. A lot of lenders don't want to lend. They don't want to lend to you because they think your current financial situation is not sufficient enough for approval. Like they think you're making 20 grand and you are requesting a loan for, let's say, 25 grand, or you're making 40 grand. I mean, that kind of stuff. So they do analysis and they think, well, you are a regular risk, you are a high risk, you are a low risk, you are a medium risk. That kind of they use those types of markers. So if you are in a situation where you keep getting denied all the time, try to enlist the help of a family member or friend, dear friend, somebody who can actually vouch for you. I mean, this is important, and just make sure that a co-signer understands the roles and implications of the co-signer role. Okay, and the co-signer also has impeccable credit history. Because if you have bad credit, for example, you don't want to have somebody else who has to co-sign a loan if that person is also someone with bad credit. You got to have something to balance things off, okay? And if you keep getting denied, maybe you need to actually start comparing lenders, because maybe one or two lenders don't like you. I mean, they just don't like your profile. Maybe they think you're too risky for them. There's nothing you can do about that. And don't take it personal. I mean, we hear a lot of folks say, well, they don't like how I look. They don't like my biology. They don't like my geography. They don't like my demographics, where I live, how I look like. Okay, they don't like where they don't like my name, that kind of stuff. No. Sometimes you, as a borrower, your profile just does not fit their quantitative models. Simple as that. Remember, credit is a game. Okay, that's all it is. It is a game. So people are not trying to we don't like your ass, so we're going to deny you. You just don't fit in the budget. I mean, not the budget. You don't fit in their calculation, in their risk mitigation model. So if that's the case, what you do is you have to actually try other lenders. Okay, try other lenders until you find a lender who will accept working with you. And there are millions of lenders in this country. If one doesn't like you, another will. It's all about keeping the trials and errors going on and not being discouraged because one person, one lender, or two lenders, or three lenders for that matter, have not approved you. And also, think about pre-qualifying for a loan. This could be a great place for you to start, because if you keep getting rejected and you're applying for a loan directly, what will happen here is that you are not only losing in terms of your credit score going down, because anytime you apply for a loan, you get a hard pull, and a hard pull actually will ding your credit score for, let's say, 10 points. But when you pre-qualify, you can actually sort of gauge your chances of approval. And that's the whole thing. And that's with a soft pull. So you're not only preserving your FICO score, but you're also able to compare and contrast several lenders. Because if you were just going for a pre-qualification for one lender, this is you kind of restricting yourself, right? You want to try 3, 4, 5 lenders to make sure that you are comfortable with the one that really offers you the right loan amount, the right interest rates, the right repayment window. In other words, the tenor of the loan must fit your cash inflows and cash outflows. The thing is, when we talk about comparing and contrasting pre-qualification loans, just make sure that you really, really think about the repayment window, because it's not about, I know a lot of folks, when they're thinking about getting a loan, they're just interested in getting the funds. In other words, I need to take care of this. I just need the money. I'm going to think about the repayment process later on. Boss, it doesn't happen that way. You want to think about things beforehand and make sure that you are in a position where you can constantly make the right decision, so you know exactly what works for you. This is really important. And one thing I want to say here is that you want to be in a situation where you are constantly changing your efforts and your research to make sure that you get the best loan for you. And that's one thing we have always talked about. You need to really think about that. Now, how long should you wait to apply again after being rejected for a loan? 3 to 6 months. 3 to 6 months. Some lenders will actually they will allow you to call something called a reconsideration loan. A reconsideration line, to sort of ask if they can actually reconsider your loan application. But overall, you want to wait. You want to take the time, let's say 3 to 6 months, to actually study your options before you reapply. Thank you so much for your application. Thank you so much for your attention. I really appreciate it. I was just talking to you about 3 sneaky things that always derail your loan application. Number 1, not knowing the loan's basic requirements. Number 2, having a high debt to income ratio. And number 3, having incomplete or erroneous information on your loan application. Thank you so much. God bless you. I will see you next time. But until then, remember, stay Marvelous.